If you're a new viewer, welcome to my channel where I'm all about sharing my life experiences, especially when I found myself out of work this year and I had to search for a way to make some extra income. And that's when I discovered about trading stock options. So now my goal is to help people that are looking for part-time work understand how I make an income trading stock options so they can understand and see how simple it really is. Maybe it motivates and inspires someone to copy what I've done so they can do it for themselves. It seems like everywhere I look, I read about and hear how jobs and careers have been affected by these global events. Businesses are reduced or sometimes even shut down and close their doors for good. I see a lot of employees getting furloughed or even let go. Well, that's exactly what happened to me in my job. My hours got reduced, and which means I didn't make as much money, right? And being out of work is just not an option. So I needed to find a way to make some extra money, right? I thought about getting a part-time job, and ideally I could work from home. And so that's when I learned about trading stock options. Now, I wasn't real sure if this is going to work, but just to be clear, trading stock options is not day trading. And I've heard about other people making $1,000 to $2,000 every month trading stock options. And that's really exactly what I needed because of my reduced income. I was really worried at first. I thought it'd be too difficult or too complicated or, even too expensive. But once I jumped into it and learned more, I found out that was really wrong, right? And so it didn't require me to have a college degree. All those charts, all the numbers, all the finance. I didn't need to spend hours watching the stock market on my computer screen. And really what I discovered, the stock charts are actually quite simple, and I really only look at three things. So that's a little bit about my background. Let's get started. So let's take a look at what exactly is a share of stock. So if we have a hypothetical company called ABC Inc., and let's say that they're a publicly traded company. What does that mean? Well, that means that they're allowed to sell shares of stock, which is direct ownership in the company, to the open market, right? So public investors like you and I can go ahead and buy shares of stock, which represent direct ownership of that company. Now, let's take this example and say that ABC Inc. wants to sell 10 million shares at $100 each. So they could put these shares on the open market and initially sell them for $100 a piece. So their market capitalization is going to be 10 million shares times the $100 each. So that's $1 billion. So for investors, they're able to trade these shares of stock in the open market. So what you should walk away with then is that a share of stock actually represents direct ownership in a specific company, right? So if you have a share of stock, that means you're a direct owner of that company. So let's take a look at how you can use these shares of stock to actually acquire profit, make money from them, right? So if an owner owns 10 shares of stock, they paid the $100 per share, so they spent $1,000 for these shares. But they may decide, I don't want these shares anymore. I'm going to sell them in the open market. And so I'm going to sell them, but I want to get $110 each for them, right? So they're going to take their 10 shares and they're going to want to sell them for $110 each, which means they're asking for a total of $1,100. So they're looking for a $100 profit, which equates to a 10% profit off their initial investment. So they'll put these shares out on the open market and they're going to be asking $110 for each share. And so a buyer's going to come along and they're going to say, yeah, you know what, I'll purchase them. They're going to pay the money and they're going to receive the 10 shares of ABC Incorporated. Now, why would they do that? Why would the buyer do this? Well, it's because their thought process tells them that ABC Incorporated is doing extremely well. They're being more profitable. And so they want to own the company because they think in the longer term, the value is going to go up. So the share of stock actually has value, right? We saw somebody pay $1,100 for those 10 shares that were initially sold for $100 each. And so these shares because they are direct ownership of a company, there's a direct correlation between the share price and what a company's doing and how well it's doing, right? So the price of the share goes up and down, and that's based on the stock market's perception of the company's different activities, right? So the stock market perception, that's us, the investors. If we think the company's going to do really well, the price will go up because we're willing to pay more based on what the company's doing. Let's take that example and look at if ABC Incorporated, let's say they create a brand new product and it goes viral, right? Everybody loves it. And as a result, their sales will go up. And then as sales go up, the profits go up as well. And because we see that as investors, we're going to be willing to pay more for each share of stock because we know the company's doing better and they're making more money and achieving higher profits. Well, the strategy that I'm using is pretty easy to understand and simple to use. But one of the things that was key for me to learn is the vocabulary, definitions, terms, and phrases that are associated with stock option trading. And I needed to learn those in order for me to be able to make money effectively. Okay, so let's get started. So the first thing to learn is, what is an option exactly? Well, an option is actually pretty straightforward. And at its basic level, an option really just says it provides you with a choice. And when you're doing stock option trading, the choice is pretty simple, right? It's either buy or sell. And because an option involves an underlying stock, it's about buying or selling a stock at a specific price on or before a specific date. And that's really what an option is, right? So it's all about buying or selling a stock at a certain price on or before a specific date. Now, there's two types of options. First, there's something called a call option, and the other type is called a put option. So let's take a look at the first one, the call option. So if I buy a call option, I'm buying it because I expect that the underlying stock will actually increase in price. Now, if I buy a put option, I expect that the underlying stock will actually decrease in price. Now, of course, with every transaction, it requires two sides, right? There needs to be a buyer and a seller. And this holds true for buying and selling or trading stock options. There's always a buyer and a seller. Now, for the strategy that I'm using, I like to focus on being the seller. I don't want to be the buyer, because if I'm the buyer, it means that I'm having to pay money. So I like to focus on the selling portion of it. Now, I could be either the buyer or the seller, but for me, I prefer being the seller. The next term is strike price. And when an option contract has a strike price, that's the predetermined price for buying or selling the underlying stock. So there's an actual dollar value assigned to that underlying stock that's a part of that option contract. The next term is expiration date. So as you might imagine, these stock option contracts don't last forever. So they're set up on purpose to have an expiration date. So it means that if a person like myself wants to exercise the option, I need to do it before or on the expiration date. If I try to do it after the expiration date, that contract is null and void. It's no longer usable. So if the expiration date is reached and the option is not exercised, then it just expires worthless. The next term is premium. And so when we're talking about stock options, the premium is the time value that is placed on a stock option before it expires. So when you're trading stock options, the more time value that there is, the more valuable it is. So when you think time value, think money. As I mentioned, the more time value before the expiration, the higher the value. And then the converse is true. The closer to the expiration date, the option contract actually gets reduced in value. For example, if a stock option has 30 days before it expires, it's worth more than that same stock option that expires in a week. So the more time there is, or time value, the more money it's worth. And the last concept I want to leave you with is that a single option contract controls 100 shares of the underlying stock. So whenever someone talks about a stock option, it always involves 100 shares of stock. If it's 2 options, then it's 200 shares of stock, 3 options, 300 shares of stock, and so on. So what is a stock option? Well, by definition, it's a contractual agreement that gives the owner, whoever holds that option, it gives them the right, but not the obligation, to trade 100 shares of stock at an agreed upon price and date. All right, so this option contract is going to be associated with some underlying stock. We have that company ABC Incorporated. So there's an option contract that controls 100 shares of stock that the option owner can either buy or sell, depending on the option type, based upon a price, specific price, and a specific date. So a couple things to point out about the option contract. So first, a single option contract controls 100 shares of stock. So whenever you hear option contract or an option, a stock option, you always want to think that one option equals 100 shares. And if it's two options, well then two options equals 200 shares, three options, 300 shares, and so on. That's always something to keep in mind. So whenever you're dealing with an option contract, the underlying stock is in the amount of 100 shares. Another characteristic of an option contract is the expiration date. So just like all contracts, there's a date that's associated with a contract. And the expiration date tells you when this option contract is no longer valid. So there's a time life or a lifespan for an option contract, and it expires on the date that's specified as the expiration. And it's typically the closing of the trading day for that expiration date. So for example, in this we see that the expiration date is September 27th, 2021, and the end of the trading day would be 4 p.m. Eastern Standard Time. And so at 4 p.m. Eastern Time on September 27th, this contract would be null and void, but it's valid up until that point. And the other characteristic of an option contract to be aware of is the strike price. So the strike price is the price of the underlying stock that is used for the buying or selling of that stock. Okay, so the option contract controls 100 shares, and in this case the underlying stock is ABC, and the strike price is $100. So the owner of this stock option has the ability to buy or sell 100 shares of ABC Incorporated at a strike price of $100. So what are the two option types that I mentioned, right? I mentioned the buy and the sell option. Well, in official terms, it's called the call option. This is the first type, call option, and that gives the owner of the option the right to buy 100 shares. So the call option, remember, that equals 100 shares of the underlying stock, which happens to be ABC Incorporated, has an expiration date of September 27th, 2021, at a strike price of $105. So the owner of this option has the right to buy 100 shares of ABC at a price of $105 up until September 27th of 2021. The other type is the put option. It's called the put option, and it gives the owner the right to sell 100 shares of the underlying stock before the expiration date at a strike price of $95. So whenever you come across an option, it's either going to be a call option or a put option, and what you want to pay attention to is the number of options, right? One option equals 100 shares, two options, 200 shares, so on and so forth. What the stock is that's associated with the option, the expiration date for this contract, this option, and then finally the strike price that is assigned to the call option itself. So when selling and buying call options, it takes two parties to be a part of that transaction, a seller and a buyer. So in this lesson, we're going to take a look at both of those parties. First, we're going to take a look at what a seller is. What's the seller offering to sell, and how do they become a seller? And then from the buyer's perspective, what's the buyer going to actually purchase, right? So they're not actually buying shares, they're buying an option, and how does that actually work? And so we'll take a look at the entire transaction, both the selling of a call option and the buying of a call option. And so by the end of this lesson, you'll understand what the definition of a seller is and what a buyer is. First, let's take a look at the seller of the call option. So there's going to be an individual who directly owns 100 shares of a particular stock. So for example, we're going to say it's ABC Incorporated that this person purchased as a part of a transaction, a previous transaction. So they have an initial investment and now they directly hold 100 shares of ABC Incorporated. Now, because they own those shares, they can actually offer someone the ability to purchase those shares away from them. So they're going to be selling the right for someone to purchase the shares away from them according to the terms of the call option, right? So the call option is going to control those 100 shares, and it's going to be tied to the stock that the owner has directly purchased. And because it is an option contract, it's going to have an expiration date, meaning how long is this option contract good for, as well as a strike price. So what's the guaranteed price that the owner of the shares will sell the shares to the buyer, whoever holds the call option. Now, the owner of the shares, when they create this call option, that's called writing a covered call. And it's a covered call because this person actually owns the shares of stock. So those shares of stock actually cover the call option. So now for the seller who creates this call option, when they write the covered call, that has some value to it, right? They want to offer the right to purchase those shares away from them. So they can actually sell that because it has a value to it. And so that seller, this person that owns the shares, is going to sell that call option to a buyer, and that buyer will then possess the rights to purchase those shares at the strike price before the expiration date. So the bottom line here is the owner of the shares is selling the right to purchase the shares away from them. And so the owner is selling a call option. Now let's look at the buyer of a call option. So this buyer is going to be an investor, and they're going to be speculating on the share price of this company, ABC Incorporated. And this investor thinks to themselves that the share price will actually exceed $105 before September 27th, 2021. So what they want to do is find a call option with a strike price that meets their target on or before the expiration date. So in our example, this investor will want to purchase a call option of the underlying stock ABC Incorporated that has a strike price of $105 before the expiration date. And so the investor is going to place a bid for that desired call option, and then once they find it and win the bid, they will end up purchasing the call option. And at that point, this investor will hold that call option, and now they retain the right to purchase those shares of stock before the expiration date at a price of $105 per share. So let's take a look at a transaction so let's see the mechanics behind what's actually occurring. So we talked about the seller actually owns 100 shares of stock. They want to sell the right for someone to purchase the shares away from them at a certain price. And so that seller is going to write a covered call for the underlying stock ABC Incorporated at a price that they determine. So in this case, they're going to set the price at $105 per share, and they're going to allow for this call option to be viable up until the expiration date of September 27th, 2021. Next, a buyer who's going to see that call option is available, will decide that they want to purchase it, and they're going to be asking the seller, how much do you want to sell that option for? And so now the seller, the person that owns those shares, is going to ask for $200 for the option. And this is called the option premium. If the buyer likes it, what they'll do is they'll pay the $200, and then the seller, in turn, will send the rights over to the buyer. So now the seller has $200, the option premium, and the buyer now holds the call option. And this call option will allow the buyer to actually purchase those shares of stock at a price of $105 per share between now and the expiration date. So it's important to note at the end of this selling and buying transaction that the seller holds the option premium and gets to keep that, the $200. but they also hold direct ownership of the 100 shares of stock. They have not given that away. The buyer paid $200, but they now hold the call option contract itself. So now this allows the buyer to purchase the underlying stock at a strike price of $105 per share before September 27th, 2021. Let's take a look at how the call option works. So just to recap, we know that a call option gives the owner the right to buy 100 shares, and it's associated with an underlying stock. In this case, for this example, it's ABC Incorporated. And one option is the equivalent of 100 shares or controls 100 shares. There's an expiration date of September 27th, 2021, and the strike price is $105. All right, so there's some individual that owns the call option, and this person has the right to exercise the option, meaning they can use the option to buy 100 shares, and they're guaranteed to buy those shares at a price of $105 per share. So that's the strike price. Now, the expiration date is relevant because the owner of this option, they need to exercise the option before it expires, right? So they're required, if they're going to use this option, they have to purchase the share. They have to purchase the shares before the option expires. So the option owner has the right but no obligation to buy the shares. And so this means that they have the opportunity to buy the shares at $105, in this case the strike price. And they can do that before September 27th, 21, but they're not obligated to do it. Next, let's take a look at some of the terms or phrases that are associated with call options. And there are three phrases in particular that I want to bring to your attention. So the first phrase is in the money, the second phrase is at the money, and the last phrase is out of the money. So I'm going to go ahead and tell you what these are, describe a little bit about them, so you have a clear understanding of the definition and what they mean in regards to a call option. So the first one is out of the money. And this scenario occurs when the share price, in this case $104.99 or below. So when the share price is below the strike price, the call option is considered out of the money. So we see the share price is $104.99, which is below the strike price of $105. So any value below $105 is considered out of the money for the call option. Next is at the money. And this occurs when the share price is the exact same price as the strike price. So in this scenario, we see that the strike price is 105 and the share price is also 105, so the call option is considered at the money. And the last phrase, in the money, this happens when the share price is actually above the strike price, and so the call option is called in the money. So we see here that the share price is $105.01, that one extra penny or higher, anything above 105 is considered in the money. So now let's take a look at an example of an out of the money call option. We can see by the chart the investor actually has control of the call option with the $105 strike price. The current price of this stock, however, is $87.52. But the investor acquired the call option because they believe that the share price will eventually exceed the strike price. Let's see what happens. The investor acquires the call option with the $105 strike price at this point here. And now as we watch the stock price, we see that it never actually gets to the $105 per share level, which means this option is considered out of the money. And so the share price ends at $95.36, which is below the strike price. And so this call option is out of the money. Next, we're going to take a look at an at the money call option. And this is when the share price is the same as the strike price, and this is called at the money. For this example, we can see here that the investor acquires the call option with the $105 strike price at this point here, we're going to watch as the share price of the stock actually reaches $105 per share. And so our option contract is considered at the money. And in this last example, we're going to show a call option that finishes in the money. So that's when the share price is above the strike price, and so the call option is considered in the money. For this example, we can see here that the investor acquires the call option with the $105 strike price at this point here. So now let's watch the stock price as it climbs above the $105 strike price. With the share price over the $105 strike price, our option is now considered in the money. And as we can see from the chart, the share price is $106.44, which is well above the $105 strike price. So the call option is in the money. Now let's take a look at how a put option works. So a put option gives the owner, the person that holds the put option, it gives them the right to sell 100 shares. So as you can see from this diagram, a put option, that one option equals 100 shares. It controls 100 shares of an underlying stock. In this example, it's ABC Incorporated. Now the option, this put option has an expiration date, September 27th, 2021, and a strike price of $95. So let's take a look more in depth now. So this person that owns the put option, they have the right to sell the 100 shares. So they can exercise that option and sell 100 shares, and they're guaranteed to get $95 per share. Now the catch is they have to sell the shares before the option expires. So sometime between now when they hold it and the expiration date of September 27th, 2021, the owner of this option can sell those shares and acquire $95 per share as a part of that sale. So this option owner, they have the opportunity or the right to sell those shares, but they're under no obligation to do so. Next, let's take a look at some of the put option terminology. In particular, we're going to look at out of the money, at the money, and in the money. So if a share price is $95.01 or higher, in other words, it's above the strike price, the put option is considered out of the money. Next, if the share price is exactly the same as the strike price, in this case $95 for the share price and $95 for the strike price, this put option is considered at the money. And then for the last option, if the share price is below the strike price, in this example it's $94.99, it's exactly 1 penny below the strike price, or anything below that. So if the share price is below the strike price, then the put option is considered in the money. And when we say it's in the money, it means that the person that owns this option and sells those shares, they're going to be guaranteed to receive $95 per share. And that's irrespective of the current price of the shares. So if the current share price is $90, the put option owner can still sell the shares for $95. You can get 2 free stocks worth between $8 and $1,000 by using my referral code down below in the description to create a Webull account and then depositing just $100. If you like this video, be sure you smash the like button so I know you've enjoyed it, and I'll be motivated to make more videos just like this one. If you want to learn about simple option trading techniques and methods for creating an income, be sure you subscribe so you get access to all my videos, and then click on the bell icon so you get notified every time I release a new video. Make a plan, take action on that plan, and start living your dream.